Having weathered the fallout of COVID-19, inflation has become enemy number one, writes Hillmarè Schulze in this week's Economy Matters column. She's with us now. Thanks for coming in.
Thank you.
So you're expecting inflation to nudge even higher this week?
Yes, definitely do. When the inflation figures are announced this week, we do think it will nudge up towards 8%. And we do not think that that will come down for the rest of this year or even in 2023.
What's going to drive it even higher?
Currently, the factors that are driving it is the oil price. We have significant supply side issues still, and of course the Ukraine-Russia war. Now, all of these things are outside of our control. It's not in our circle of influence, and we do not see these main factors actually calming down within the next 4 to 6 months.
So a lot of it is imported inflation?
Yes.
What about our local inflation?
I think in terms of local inflation, we are going to push to get that sort of within our control. We will see the OCR going up again to try and curb the inflation. But there are some real structural issues in our economy that needs to be addressed long term for us to actually address inflation.
What are those structural issues?
Productivity, I think, is one of the main issues. It has eluded us for a very, very long time, for decades, and it's been a conundrum in our economy and in our country, and that is something we definitely have to address.
What would high productivity mean?
High productivity would mean that we actually produce more for what we put into our economy, meaning that we can produce more things that we can export and that will actually push prices down.
So to date, have the OCR hikes had the desired effect?
Not totally convinced it had the desired effect. It is the only tool that we can use on the monetary side, but it should not be the only tool. It should be a combination of monetary and fiscal policy to address this. The OCR is not going to be the magic bullet.
So the other tool you're expecting is productivity?
Yes. So meaning that we have to look at the fiscal side and also in terms of how we invest and what we invest in.
Is that a feasible lever that could be added to the RBNZ's mandate?
Oh, that's going to be a tough one. I think fiscal policy will stay within central bank, within government, and the central bank is tasked with monetary policy. It is not a responsibility to look after fiscal policy.
Okay. In terms of having productivity as a lever, though, is that a likely option in the future?
I think productivity should be one of the indicators that we look at within all our levers, because it is a result of monetary and fiscal impact. It's not only one or the other. It is both of those policies need to work in tandem for us to increase productivity.
Why hasn't the Reserve Bank's hikes to date had that desired effect of bringing inflation down then? Is it because there's too much imported inflation, there's too much risk around the world at the moment?
I think it is definitely too much imported inflation. We are a small economy, so if the rest of the world sneezes, we get flu. So it does impact significantly on our inflation.
And as you say, those risks are going to continue for a number of months. When might we start to see Ukraine and the oil prices start to just pull back a little bit?
Well, I can't say about the Ukraine-Russia war. We don't know, but I think we are not that optimistic in terms of the rest of this year and even 2023, seeing any of those being pulled back.
When might we see the inflation come back down to that, midpoint target band? Not for another year or two?
Definitely not for another at least 18 months. Before we would maybe see inflation starting slightly coming down.
Do you think the Reserve Bank needs to be a little bit more forceful in its rate hikes? It did consider at the last meeting going 75 basis points. Do you think it should do something like that?
No, I don't. It's very hard because the issue is around debt and household debt and the cost of living, which is a significant pressure point for us at the moment. And if you look at our economy, a lot of us have said this before, as we are a housing economy with a bit of other things added onto it. So if you are pushing that, it is going to hit mortgages, and that is a significant part of our economy.
It's already coming into play, though. Households are facing higher mortgage rates right now, upwards of 5%.
Yes.
So they could expect those to go even higher?
The indications are, and we've seen some of the retail banks have already started hiking the interest rates, and we do not think that will actually ease until maybe end of next year.
What does this all mean for the general state of the economy? Having higher interest rates, a higher OCR and inflation.
It means that we might have to start talking about the big R, about recession, and that it is a real threat within the next 6 to 12 months for our economy. And we know when we move into a recession, everything that goes with that, and significant pressure on our households. And this time round, we have an economic shock every 10 years or so, but this time round, household debt is significantly higher.
Will it be a sustained recession, or will it be quarterly? Sometimes, 2 quarters in a row, then we might see some growth.
Hopefully, this economic shock is very different than any of our previous economic shocks, and we sort of haven't got a textbook that tells us how this is actually going to look. So economists have wildly different ideas of how the outcome will actually be, and if it's going to be only 2 quarters and it's going to be a short shock. It totally depends on what happens with the Ukraine war, what happens with oil, and if we can actually sort out our supply side.
Hillmarè Schulze, thanks for coming in.
Thank you, John.